For traders that have emailed and asked, the links for the free downloads are in the description box below. Just click on the link or copy and paste and put that in your browser. The 4-step method to high performance trading and the 7-step daily routine for high performance traders create the rituals, the mindset, and the winning attitude to master the markets. Bulletproof yourself with your daily routine and your habits. Force yourself to be getting better, 1% better every single day. How good can you get, traders? Again, the free downloads, the links are down below. They're both free courses. Let's get started. Hey traders, Stacey Burke from Stacey Burke Trading. Today we're going to be talking about day 3 setups when we have major red news on the calendar. We have the Fed later today in the US. We had PPI in the 8:30 a.m. New York time. And I received several emails and questions from traders regarding trading major news days and also trading the other sessions on these days. Now, if you've traded on Fed day before, I know lots of traders don't even bother. I come to the screen with the same process each day, looking for the New York Open specifically in that middle hour for an opportunity. But again, on these days, because of major news and the Fed, there can be some better opportunities for traders in Asia and London on day 3. Again, coming back to understanding the day count, day 1, day 2, Monday, Tuesday, high and low of the week. Potentially we may have already taken out weekly levels or be at lows of the month or heading back towards the lows. So again, reviewing your process, your best trade setups, sticking to understanding your best trade setups, how they will evolve and present, and then also a question regarding why I walk away after 1 hour. So let's get started. Again, just to review some simple things, I'll change that to red. When I'm looking for the basic pattern, I'm looking for day 1, day 2, break in structure maybe, day 3 for a large move down. That can happen sometimes on the course of a day. And there's your 3 peaks. We talked about this when it's an inside day or we get an inside bar. We can often get a move that moves away from the previous day's low or high and gives us 3 peaks, 1 peak, 2 peak, 3 peaks, and then a trade potentially. For me in the US, obviously this can happen in London. This can be pre-market. This can be Asia. This can be US, Asia, London. Many different combinations of this. And the same thing applies on the upside. We can get what I call the day 0 setup. We can have a peak formation high, peak formation low, peak formation high. Market comes back inside and trends. That's my day 0 setup. This can happen over day 1, day 2, day 3. So you've heard me mention the expression level 1, level 2, day 2, level 2 trend trade. And often that's when we will get, for example, a day 1 market puts a high in place and then day 2 continues with a trend trade. Sometimes we will see day 1, day 2 come down and reverse on day 3 and trend on day 3. Same scenario, just a different variation in terms of how they will move the market in order to trick and confuse you. But the basic model, level 1, level 2, level 3, and again, we look at that on the upside. We can get three pushes to the downside for a reversal trade. And the point I'm trying to make is that when there's major news on the calendar, we can still have these types of setups for large moves down. And often the news can act as the catalyst for that large move. And I talk about first bounce, we get an explosive move, and I will re-enter the market on that first bounce in line with the original explosion. And that can often on gold indexes, oil, and sometimes major pairs. That can be 50, 100 pip move, depending on the strength of that index or that instrument and the market itself. Often what we find on Fed day is that the market will move around, and by the time, and sometimes this can happen over 3 days as well, we can actually get a market that will trade on Monday, to Mr. Red, Tuesday, Wednesday, and then we get the Fed, and it might even bang around before continuing its move. It might just bang one side and continue in one direction, but typically what we'll often see is that the Fed will hit both sides, which is why on a Fed day, I'm expecting that the market can move in London or Asia, and it can move in London, and it looks like it's going to move in the US, and then it might even have a small move depending on the instrument, and it stays in a range-bound market until later, and they might trigger breakouts, hit stops, whip it back and forth, destroy people's accounts. And then the next day, though, what we can see, oftentimes we will see a market potentially that overnight may, I will change that, overnight may end up now coiling for an explosive move for a trend day. Sometimes we can see these markets break out and go 3 levels the next day and roll over for large moves Thursday, Friday. All kinds of combinations. The point I'm trying to make is that often, just prior to the Fed, you will not find me anywhere near the screen. And coming back to the question, why do I leave after 1 hour? Because I'm looking for my trade setups. And based on New York Open, I'm looking for markets to give me my trade, lock it in, and get off the screen. These are reproducible, scalable opportunities that show up over and over again. The longer traders trade outside of certain windows, we start to see the algorithms come to work, and they trap people, false beliefs, counter trending, and false moves and everything else. And it can lead traders to over trading. They'll take impulsive trades. They will over leverage. They will take get even trades. They will take get back to high watermark trades, which are when you've been at a certain point in profit, you take a loser, and next thing you know, you're trying to make back what you made that day, and you double or triple your loss. We see revenge trading. We see anger trading. I'll change that. And you've heard me say this over and over again. You want back testing. Back test yourself. Bulletproof your process. Because the process is what each day you should be getting further and further evolved and refining your excellence. And that's what will keep you out of all this other garbage, because then you realize when you come to the screen that you only need 1 or 2 great trades. 1 or 2 great trades a day or a week, depending on the size that you're trading and the instruments that you're trading. Rinse and repeat. Scale them up in size. Understand which trades are sizable. And I love it because I get these people who hate when I say this stuff, and I love it because that equals cash. That equals money. And the better and bigger that you can get at the ones that are sizable, the more money you're going to make. You can focus on all kinds of other gobbledygook and everything else, but if you learn to size into stuff that's going to blow off, you can make a lot of money. So if we just have a quick run through the pairs and look at the instruments and then come back to our thesis, our day 1, day 2, day 3, we see our day 1 breakout on Monday on the Canadian dollar. Day 2 goes vertical, and again, I look at this like a pump and dump situation. Whenever I see a vertical move in a market, day 1, day 2, I'm looking again for that stair step up. we see the market pump up in the Asian session. But then we talked about this yesterday, the break in structure, and then the peak formation V-top in the gap for traders who traded the end of the London window. We had our peak formation high. The market traded back up into the peak formation high for the short trade later in the session. So the 3-hour window acted as order flow, 1 push, 2 push, 3 pushes. For those traders who can't see my mouse, I don't know what to tell you. I don't have a black pointer. You just have to go look at your charts. The patterns are the same on your charts. But we come back to the Fed day. We have PPI in the U.S. session. This pair would not even be on my lookout during the U.S. session. And again, just reiterating the consolidation prior to the Fed. Day 3, we're inside. We have 3 peaks. Definitely not what I'm looking for an opportunity in the U.S. session. Traders may have had a nice 25 pip scalp on the 3rd peak inside of that peak formation at the quarter level. We have a high established at the quarter level. They traded up into it. Our 3rd peak takes out the lower high of the London window. Traders may have had a 25 pip scalp in the New York open session. Let's take a look at the smaller chart, 1 minute chart. If my thesis was to be shorting up high, market is on the front side of this move, pump up into the high of the day. We get our breakdown and then our retest into the high, New York open, and then our engulfment for the short trade. Again, not saying this is a high quality setup, but traders who wanted to trade on the inside of this range on the consolidation, I view this as a box they're getting ready. They will most likely hit the high and low of the week. But coming back to some simple concepts on the day itself. Last night locks in a low and the market goes up 1, 2, 3 levels of rise, meaning my quarter level would be my 3rd level for a short trade opportunity. 3 levels of rise, thesis being if on a normal given day, we might retest the low. But on a day 3 where we're looking to sell high, you'll notice that the peak formations are trading down. They're getting traders to short this into the low of the day. 3 levels of rise for short trades up top into the low of the day, and it's not going anywhere. Most likely we'll see both sides of this consolidation get hit in the Fed, but again, not even on my list. Fed day inside, not interested. Swiss franc, we have our day 1 runner. Day 2 triggers our breakout traders, giving us a nice low-hanging fruit trade yesterday in a broken down market. It broke through the low of the Asian session. We get our 1st hour and then the extended stop hunt into the New York open, into the 75 level up top for a short trade back down through the low of the day. So again, low-hanging fruit setup. Day 2 breaks down inside. Coming back to, again, the concept of the stair step up, the elevator down, but we're day 2. So this may now be, day 2 may be forming our low of the week. Again, we're inside, we have Fed. You'll notice again, we're inside on the day. If I have an inside day, I'm looking for 3 peaks. Peak formation high in Asia sets our high of the day. And then the market proceeds to work down 1 push, 2 pushes at the London Open. We get a 3rd push into the beginning of that 1st hour. New York Open trades back up to our high of the day. 1 push, 2 pushes, and a 3rd push down in the gap into the 12 candle US window. So again, targeting potentially on the high of the week, maybe on the Fed. No idea. We're inside though, which again, day 1, day 2, day 3, this inside bar could also act as order flow for a move back down later in the week. Now this Japanese yen is absolutely mind-boggling. If we look at the weekly chart, we'll just put a blank chart up here. if you're trying to counter trend this market right now, you might have more success just actually going with the trend. This is a weekly chart, and we see this market having broken out of a very large consolidation heading into this year, February, March, and then trading out of that geometrical structure. If we just take a measured move of that range, approximation measured move of that range, we still can see this market targeting potentially up towards that 150, 149, 150 area. So again, for traders who may be looking to counter trend the Japanese yen or short it because it's going up and making new highs, you may want to rethink that. Again, the expression I talked about was being on the front side of the move. Regardless, if I was looking for a short, I would want to see a break in structure first. Break in structure, first red day, anything of that nature, but we still have a day zero situation, peak formation low, peak formation high, the consolidation, and then the trend trade on day 3. So again, if you're not familiar with the day zero setup, peak formation low, we'll just tighten this up a bit for people to see. Day 1, day 2, peak formation high, the consolidation inside, and then the trend trade on day 3. This is an ideal setup opportunity for traders who are just looking to continue with the trend in that London window on a Fed day, day 3 trend day. British pound broke the low of the week, and again we had a peak formation high on day 2. Again, we talked about being inside this market, triggered the low of Monday, and then we start our count. Low of the day breaks out, 1 push, breaks structure. 2 pushes into the US session and a vertical move for the 3rd push to the high. Big pump and dump setup, 25 to 50 pips. This actually went to the 3rd level outside of the 100 pip box before breaking down with our M structure. And you'll notice the 1, 2, 3 at the high of the day before collapsing and coming back down to the low of the week. Reversal underneath. So again, trap volume on top, above the previous day's high. And then we have trap volume down low, below the low of Tuesday, day 1, day 2, day 3. And then we have 3 levels of rise. 1 push, 2 pushes into the gap in the London window, and now we are currently on our 3rd push to the high of the day. We could see this market continue to push higher on the 3rd push, going after traders who were short, or we may see this market come back into low-hanging fruit and explode on the Fed. No idea, don't care. But again, we're back inside, and I look at the 3 peaks, the 3 levels of rise on the British pound, back up into the peak formation. We could see a nice possible break to the top side, triggering longs, the high of the week, and then a vertical move back down. Don't know, don't care, but vertical move back down through the escalator and the elevator back down. In the euro, again, we see the peak formation above Monday's high. This break in structure on the inside, similar to the Wyckoff accumulation pattern, day 1, day 2, peak formation high, dropping it back down low, the creeper down into the low of the week and the month. I believe we'll just check this on the daily. Not quite the low of the month. Well, it's the low of October, but still haven't taken out the low of September, but we're trading down into the low, day 1, day 2, day 3. Creeping trend down, lower highs. Again, you'll notice the consolidated volume below the quarter level, trapping it into the previous day's low. We could see something similar possibly trigger the breakout traders before going back vertical. Don't know. I have no idea. It could take out the low of September. But again, no stair step on day 3. The peak formations are back up as opposed to being day 1, day 2, break in structure, day 3 back inside for a short squeeze back up. Fed day, consolidated trapped volume. When I have major news on the calendar, Fed and also US news, I will often look to oil. As I've said before, I tend to feel that oil is the least likely to react to certain news. Now, again, I have nothing to substantiate that other than my own opinions. But again, the New York Open 12 candle window. We had first red day on Monday. We talked about this yesterday. We had 3 peaks for the high of the day opportunity in London for a very sizable trade opportunity, and then the low-hanging fruit continuation in the US session. But we still have the same type of opportunity after our first red day when we get inside of a previous day's low. You've heard me repeat this again, 3 peaks. That's the 3 levels of rise heading into a session window. And when you see volume getting trapped higher and higher, I hope you're thinking opportunity. Opportunity knocks. We have a pin hammer in the first 15 minutes of the US trading session. Now, we did have major news on the calendar with PPI. And this market proceeded to drop. We had volume trapped up high. And again, with major news on the calendar, you've heard me say I won't trade in front of the news. But again, with oil, I will take certain trades if the setup is there. We had a peak formation engulfment for an early starter. But the first bounce, I treat it the same as any other day. First bounce opportunity. There were 2 fantastic first bounce opportunities. And again, if you've been following oil long enough, I suggest to not counter trend oil. I said this yesterday, do not counter trend the indexes or oil if you're inside. And again, coming back to the understanding and the thesis that we may be targeting again 3 levels of rise, the low of the day. So if you're counter trending, thinking that this market is potentially going to reverse, as we can see, this market is still continuing to move lower. But the first bounce trade lines you up with the original explosive move from the high of the day, targeting the low of the day. 2 fantastic opportunities prior to the New York Open after the news. And thesis being then, we haven't taken out the low of the day. Heading into New York, I'll just review that again. Heading into New York, we see that the market has, in that second hour, gotten to the low of the day, but not the low of the month or the week. And what's important about that is that once New York opens, they give us the same opportunity. Peak formation high in the first 15 minutes. So again, in a broken down market, a lot of retail traders will look to counter trend a strongly moving market. We had first red day, we had the follow through on day 2. We're in day 3, and the market has broken down from the high of the day. We have a peak formation high made in the first 15 minutes. The market then proceeds to trade back up to that peak formation high at the beginning of the third hour. It breaks down underneath of that peak formation high and gives an absolutely fantastic opportunity to continue the short trade inside of the peak formation in a broken down market. 3 levels of rise, 1 push, peak formation, 1 push, 2 push, 3 pushes, 3 levels of rise for an absolutely beautiful 75 plus pip collapse down through the low of the day. And we see the same thing. Traders trying to counter trend this. The market pushes up from 3 levels, 1 push, 2 pushes, 3 pushes, breaks down, pulls back into the peak formation before rolling over, collapsing another 75 pips. You've heard me say this. The indexes, S&P, do not counter trend. And if you are going to counter trend, have a best trade setup in order to do that. Otherwise, you will blow your account out. You'll notice again some simple things. Volume gets trapped up above the low. volume gets trapped up above the low. They work the high, work the high, work the high, breaks down, consolidates, and goes vertical. So in order to avoid catastrophe, if you are going to take these opportunities, stay in line with the bigger picture. Again, 15-minute charts define my thesis, 3 levels of rise. This market has no reason to all of a sudden go vertically back to the high. Day 1, day 2, 3 levels of rise, day 3. This is a continuation trade at this time. We had lows over to the left side of our screen, low-hanging fruit. Who's in the money? Opportunities for easy follow-through trades on the Fed day. This is a very, very clean textbook chart. NASDAQ, again, on Fed day, high probability that we can see a market go into consolidation. We're inside. So if I was to do anything at all, I want the textbook 3 peaks. We get that on the NASDAQ into the 12 candle window. And again, you'll notice the higher lows. 3 peaks and higher lows inside without taking out the high heading into the US 12 candle window. We have our broken down market at the New York Open. We get a vertical pump into the breakdown. 1 push, 2 pushes, 3 pushes, and an engulfment right at the beginning of the 3rd hour. Think of it. 15 minutes working the high, putting a high in place. Another 15 minutes trapping volume. 3 levels of rise for an easy 50 pip trade. So some traders say, well, why didn't you go long? Well, that's not my play. That's not my trade setup. There are traders who want to do that and go long. Again, this to me is a simple trade setup. It's a broken down market. We're retesting the low. Obviously, the creeping trend down is a giveaway that they might be putting a low in place. But this is a easy follow through New York Open 1 hour a day trading opportunity. And for those traders who seem to still not like my approach, you're missing this valuable piece of information. Nobody cares what you like. I'll tell you what I like. I like Benjamins. And if you're not making Benjamins, maybe you should try something different, because Benjamins is what it's all about. And I know that people don't like that, and too bad. That's what trading's all about. Very similar setup on the S&P. Again, we're inside. We have our pump into the close of the session. So again, we talked about this in previous videos. Pay attention to the closes. How do they close the market? We got a nice pump. They continue to pump it in Asia. First peak formation, 1 push. 2 pushes in the Europe-London window. So some traders asked, why don't you consider that a peak formation? Because I'm looking for the peak formations that are in the equity sessions themselves. London in that window. We get our 2nd push. 3rd push in the gap, which is again back up to the high, but then we get our little stair step, 1 push, 2 push, and the market breaks down. There's our front side, still on the front side. They break down. So pay attention to this. They break down before the New York Open. That's called a break in structure. Again, I'm just reminding people I'm looking for setups. So when I come to the screen on a Fed day, I'm not looking for level 3 5-star opportunity, because we don't have our stair step, but we do have a pump and dump opportunity on the indexes. We again take out the peak formation high. We get 1 push, 2 pushes, and a 3rd push up into the high as the 3rd hour opens. We get a market that breaks down, consolidates, and continues the move for a very explosive, even on the blow off on the 3rd leg, for 75 pips in 3 minutes. So these opportunities, for traders who don't like the volatility, that's no problem at all. But again, you're wherever you take a trade, how you manage your risk should be constant. So you're never at more risk on any other opportunity. It's understanding where you're at in the move. And is there a setup? This is a pump and dump, but we have a Fed situation. So again, if you're trading these setups, I'm only looking for a scalp. Again, reiterating that I felt on a day like this, where it's almost a given that they will consolidate volume inside. They will consolidate volume inside of the highs and lows of the range. I will often look to focus on oil because it may be a better setup or least likely to react to the news. Which brings us to gold. And gold, again, we have our peak formation high on Tuesday. And again, this may be an accumulation box for a day zero explosion after the Fed or tomorrow in Asia. Back up through these highs, depends on what happens. But if you've been trading gold long enough, this is a dead set chart pattern for an absolutely, totally avoid type of situation. When they go sideways in this gap and the range starts to tighten, I won't even look at gold. I have no interest because of exactly what's happening here. It's Fed day. To me, this is just consolidating the volume inside, trapping people in junk that won't go anywhere until later, just prior to the Fed. And then we'll most likely see both sides get triggered. They might trigger, if they trigger the high first, they're probably going to go down. If they trigger the low first, they're probably going to go up. This peak formation, again, if we have peak formation low, peak formation high, we could see this market coil into the end of the U.S. session for an explosive reversal. Again, I don't predict. I have no idea. But if I see a day zero setup, I will be looking for something explosive, possibly in Asia, depending on how the Fed trades today. So again, on major news day, I want to avoid the junk. I want to avoid the consolidation. I'm looking for simple, clean charts. I know there are those of you who don't trade oil or do not have it available, or your spreads are too big, whatever. Again, it's a very, very textbook clean chart today. Again, looking at the other consolidated pairs, in the currencies, we see New Zealand dollar, Aussie dollar. Again, it's triggered the previous day's low on day 3, but we're trapping volume down in this lower 25 pip box. Wouldn't even consider touching anything remotely close on a day like this. And this is exactly why. They're just trapping volume. People who are trading these instruments. Pound was a bit more, obviously 3 levels, but again, started to go wiki as we headed into the U.S. session. I know there are some traders that looked at that and possibly went long back to the high, but we see our 3 levels. Again, we're inside, and this market could do anything. I have no idea. We've triggered the previous day's low, so most likely I think we could see a move to the high first, and maybe even a move right back down to the low, hitting both sides. No idea. I just like to avoid this type of garbage. And again, the euro creeping back into a peak formation low, and no idea what this market will do. Time will tell. I'll come back tomorrow though, and I'll follow the same process. I will look for the setups, the patterns that show up, which charts are the cleanest, peak formations, stop hunts, and then the timing window. Specifically for me, New York Open, if you're trading London, obviously the London market. Example yesterday on the euro, we see the London market actually opening on the way up to the high, which should give traders a good thesis that the move is already underway and that they're trapping volume on one side or the other. Peak formation, break in structure, creeping trend down for a vertical move through the high. 1 push, 2 push, 3 pushes before breaking the previous day's high. 45 minutes. I reiterate, 30 to 45 minutes typically in that first hour will establish one of the extremes. And then from there you can establish your thesis either for a continuation trade, first bounce, or peak formation high or low. If you're heading into the New York Open, again, pin hammers, 15-minute charts, 1-minute entries, levels, timings, high and low of the day. Stay away from the junk traders. Stay safe. Plenty of great trades. Tomorrow and Friday could both be very, very lucrative opportunities. Have a great session, and may the markets go with you.